Before you consider raising the rent on your rental property, let's take a look behind the scenes to see what's already happening. There may be opportunity to increase profit without asking your tenant to pay more. In this video, we're going to look at other areas investors often overlook. If you're a real estate investor and you ever thought to yourself, am I doing this bookkeeping thing right? Then this video is for you. Maybe you own a rental property and you aren't sure what numbers you should be tracking. Maybe you're doing your first flip and you feel overwhelmed by QuickBooks and settlement statement. Or maybe you own a short-term rental and you still have questions throughout the year. As a real estate bookkeeper, I help create processes to keep you organized throughout the year so you know exactly where your money is going, which property is profitable, and what to do before you buy, sell, or scale. If any of that sounds familiar, then you're in the right place. This brings us to our first fix. Before you can improve profit, you need to complete an expense audit. An expense audit is looking at a list of all of your expenses and getting rid of unnecessary charges. Here's what I mean by an expense audit. If you're going through your list of expenses and you see that you're paying for Amazon Prime on your business account, but you already have one on your personal account, you may have done like I did and subscribed to a 30-day trial and forgot to cancel. Let's go ahead and get rid of that monthly fee. Or remember when you first started real estate, you got excited, you started paying $150 a month for the course, but you never hit play. Maybe that's a charge that we need to place on hold for right now until you're ready to actually take the course and complete. Or as you're looking through your expenses, you see that you had requested a contractor to come out and do a paint retouch-up, which will typically cost about $150, but you've been charged for a whole wall repaint. Or you may have that charge of $500 when you told them to come out and clean the carpet, but they charge you for replacing the carpet. Or maybe you're being charged $50 a month for a business office phone, but you're always out in the field, so you're not really using your phone. These unnecessary charges can lead to low cash flow, profit you're losing without realizing, low cash reserves, and financial struggles. Here's 5 helpful hints. 1, you want to review your expenses monthly. You also want to compare it month over month to make sure that the prices are staying consistent. You want to make sure that you're investigating unusual increases, make sure all reoccurring charges are valid, and ensure that you're tracking your vendor costs and making sure that you're not being overcharged for something you didn't ask for. Fix number 2, insurance shopping. Insurance shopping is comparing prices to reduce unnecessary costs. That's like paying a $400 monthly bill at Geico, but had you shopped around, you could have found out that you would have saved almost $200 to $300 more had you switched to State Farm. And that's exactly what happened. When your policy renewals increase, coverage changes, property value shifts, rates quietly rise, bundle discounts expire, but you never reviewed the policy and now you're overpaying. Now your cash flow is reduced, you have higher monthly expense, thinner profit margin, and it's harder to grow your reserves. So here's a helpful hint. Review your policy yearly. Seek out an insurance agent to help you compare quotes. Ask about bundle discount and go through your policy and remove unnecessary charges so you can save more. Fix number 3, maintenance strategy. Repairs are reactive and usually cost more than preventative maintenance. Maintenance strategy is fixing a small problem before it becomes expensive. That's like ignoring a small leak until the entire ceiling collapses. Most investors don't even notice the problem until something like this happens. During a routine maintenance, you have an AC tech that lets you know you have a failing capacitor that equals $200. But instead of getting it replaced, you ignore it. Now your HVAC goes out and it's the peak time of the summer. Now you're looking at an $1,800 problem. Or you have that small crack in the wall where if you would have taken drywall patch or a small paint touch-up, would have only cost about $150 to $200. Now you're looking at a possible roof replacement. Or you have a maintenance request from your tenant, but they asked you to replace the latch on the fence. You never got to it. So now they feel like any type of maintenance request you're going to ignore. So they never told you about the water issue in the wall. And now you have a $2,000 plumbing issue or even more. These issues can lead to expensive repairs, tenant frustration, vacancy risk, a larger financial disruption, or even worse, depletion of your reserves. Here's a helpful tip. Start by doing quarterly inspection. If you can, set up a schedule to do preventative maintenance on different things on your property. Track repair history. Fix issues early. And most importantly, budget your maintenance reserve. Fix number 4, tax planning. Many investors focus on making money, but ignore how much money is lost due to taxes. Tax planning is structuring expenses to legally reduce taxes. That's like working overtime, but forgetting the higher the earning, the higher the taxes. Without tax planning, the problem usually don't show up until much later. Things such as mileage not tracked, major repairs improperly categorized as expensive, depreciation ignored, receipts missing, and personal expenses mixed with. All of this can lead to overpaying taxes, lower cash flow, reduced reserves, less money to use towards your reinvestment, and a weaker portfolio growth. So do this instead. Separate your business account. Make sure you're saving your receipts. If you can't remember to put your receipts in a safe place, then do what I do. Take a picture of it. You want to track mileage and make sure that you're categorizing weekly on your transaction. And finally, make sure you're working with your CPA to get an idea of what you should be putting away every month for taxes. And finally, fix number 5, which is vendor negotiation. The first quote should not automatically be the final price. Vendor negotiation is reducing expenses through a better price. That's like buying the first car you see without comparing other prices. And that's exactly what happens when your contractor rate increases, landscaping costs rise, cleaning fee increases, your maintenance invoices are varying, emergency vendors overcharge, and long-term vendors stop competing. All of these lead to reduced profit, unnecessary overspending, weaker cash flow, tighter reserve, and makes it harder to scale. So do this instead. Get multiple quotes. Build your vendor relationship. Negotiate repeat work discount. Review your invoices carefully. Compare yearly vendor costs. If your cash flow is tight, don't immediately assume that your property needs more rent. Sometimes a real problem is just operational inefficiency. Strong investors don't just increase revenue. They control expenses, protect reserves, and improve financial discipline. Because increasing cash flow is not just about making more money. It's about keeping more of the money the property is already making.